I am totally aware, as someone who actually has property and tries to do business in Italy. Italy is a very strange country in terms of doing business. Strange country in terms of their budget. But, Wilf, it's the third largest bond market in the world.
Third largest bond market in the world. Other than Greece, it's the highest debt to GDP in Europe at 130% of debt to GDP. The interesting thing about what's going on in Italy at the moment, I don't think we're talking about two crucial things that we did a couple of years ago, which would be more risky to the US stock market. One, we're not talking about a country that wants to leave the single currency.
Right.
That is not on the horizon. We're also not looking at big contagion. So yes, the 10-year on the Italian bond went up to 3.6%. It's jumped 23 basis points this morning, and the spread over German debt is now at 3%. But we're not seeing contagion across the rest of Europe. So,
because of the central bank that just won't let it happen?
Because the central bank is still supporting things, which raises another question: can they raise rates, like people think?
Right.
But we're not talking about two of those doomsday scenarios. All of that said, I think this has played out for Mr. Salvini and Mr. Di Maio, the populist leaders in Italy, better than they could have hoped. Because what they have got from the European Commission over the weekend is a firm rebuke for doing something that didn't even really involve breaking the rules. Right. They announced that their budget deficit was going to be 2.4% of GDP. That was higher than expected, was expected at 1.5, but it was still below the 3% rule that they had. And yet they've got this rebuke from the European Commission, and it plays into their hands to talk up their populist issues more, and it hurts that sort of centrist Brussels rhetoric across not just Italy, but across all of Europe. And I think next May, the European elections are going to be very interesting to watch.
Now, I don't want to over-accentuate the role of either Europe or China here this morning. Obviously, we have a closed bond market, so I tend to look at international more importantly today. When we sit back and we look at that employment number on Friday, there are many people who read it as entirely strong. They did not break down the units of where the jobs are being acquired. It's not healthcare. Healthcare had been inflationary. It was private, literally white collar. I think people are fearing the Fed, and that a lot of this sell-off has to do with Jerome Powell simply saying, listen, in his own right, we're dropping data dependency. What we're going for is, here's your roadmap, and we could overshoot. So now let's put it all together. Europe is clearly slowing. And I know there was some good news out of Germany, but I don't see much. And so then it comes back to me.
Inflation was recently slipped a bit in core inflation figure.
But are we underestimating Brexit in this country?
There's so many moving parts on Brexit. I mean, I think in the short term, we are more likely to have a no deal today than we were 6 months ago. But I still think a deal is the most likely outcome.
Okay.
Just because you would expect the sides to come together in the interests of sensibility. But that's uncertain. I mean, the question is, does that really hurt the US or not? And just to finish the point, as we mentioned with Italy.
I come to you clearly because you have tremendous background in Europe, and I'm playing it to my advantage because I lack the knowledge that you have. So I like to be able to put the context why our market's down. And our market's down because of Europe.
It's down because of Europe. It's down because of China today. And we need to highlight that China's playing catch-up, that Italy probably doesn't have contagion, albeit these are real big issues to watch over the next 6 to 12 months politically. Just on the point of contagion with Italy, just quickly, we've got the, from Barclays note, the exposure of the US banks to Italy debt. And they're not groundbreaking numbers.
No.
So even though we see days when the Italian banks are down sharply, which makes sense quite clearly, Citi's the one with the biggest exposure. Goldman Sachs, for its market cap, is quite high relative to those US banks. This is as year-end at 2017. We don't have more up-to-date figures. But again, days we see the US banks selling off because Unicredit's selling off, you can look at that and think, okay, that's a little bit overdone.
I am a little surprised that Citi's that high. I would say that Citi and JP Morgan report on Friday. JP Morgan talking about good loan growth. Citi really not emphasizing loan growth. I want to hear what they have to say about trade. You know, when you try to do business in Mexico with Citi, they're not allowed to. Part of the new NAFTA agreement is a consolidation. I mean, will Mike Corbat talk about the big costs that could be taken out? That's important. He's still buying back, right at this level, he might be buying back as much as 10% of this number of shares. But that is Friday's business. That's what's critical. We do not have any big earnings until Friday, but those earnings are gigantic. And the bank stocks are really flirting with highs. You know, they're at the cusp of we don't know. It's cusp of we don't know.
And they were the best performing sector last week. The financials broadly at 1.9%. But the rates were soaring, so they could have performed better, and they've been low. We'll, of course, see the banks report.
Well, let's see if there's
Friday.
any